Hello and welcome to a very, very special episode. The spotlight really on the state of India's economy. We have seen GDP growth at its lowest and slowest in 7 quarters. We have seen retail inflation above the 6% mark. So, what really are the expectations from the upcoming RBI monetary policy? Well, to decode all of that and share the expectations, I'm joined by Sanchita Mukherjee, Senior Business Economist, Mitali Nikor, Senior Economist. Thank you both very much for your time. Sanjita, first to you. Your expectations from the upcoming RBI monetary policy, increasingly with the growth and inflation picture, the spotlight on what will happen.
Thank you so much. It's always a pleasure to join you, Sakshi and Mitali. The way I see it is that what we just discussed, in fact, in our last interview as well, that the Indian economy was slowing down, and that was coming out to be pretty apparent even from the listed space. One look at the earnings numbers, the inflation numbers, the manufacturing, the PMI numbers, the factory output, the capex, the GST collections, tax collections, all of that, I think we have previously discussed as well. So there is undoubtedly a phase in which the Indian economy has entered a slowdown. Now, what we need to understand with respect to the RBI Monetary Policy Committee meeting, which has started today, is the fact in the last Monetary Policy Committee meeting, it was decided to take a neutral stance and to have a look at the inflation bit, especially the food inflation, because of the vagaries of the monsoon. This time we've had a very heavy rainfall. Right now we're in a situation in which the winter is looking a little dicey in terms of we do not know how the weather would affect the crop rotation cycle, right? Although we've had a couple of seasons of good crop, Rabi and Kharif looks to be good. RBI especially is worried on the food inflation bit, and rightfully so, because it does affect the common man. Having said all of that, I think the crux of the problem which has happened has been the extremely tight regulation which has been on the credit front, on the MFIs, which is the lending institutions, the NBFC, because in 2020 there's been slight rule regulation change, and a lot of NBFCs were lending. They were given the freedom to lend with their own credit regulations and all of that. A lot of them lent ahead, which was a big discomfort with RBI. So starting March this year, the lending has been very slow. The deposit taking by banks has been slow. So RBI is a little concerned with the loan to deposit ratio. I don't see it as a structural problem. It is something in which the regulator rightfully is trying to ensure that the books are good and you do not have an NPA situation. However, having said that, these high interest rates have actually slowed down the economy. Because if the banks are not actively lending, if the NBFCs have really, really been tightened in their lending norms, liquidity is low in the system, it is really affecting day-to-day businesses, the earnings growth, and overall, I mean, if you look at the mortgages numbers, the home loan numbers, they're at an all-time low. So the urban demand, the consumption is very, very muted. If one were to see even the consumption during the festive season, we have a lot of hopes in this wedding season. But overall, I think the consumer sentiment has been very muted. I think RBI will do very well to consider the liquidity situation, if not cutting interest rates at this point in time, which I think is the need of the hour to spur that consumption and to spur the demand. See, because let's understand economically also, there is very little one can do in terms of controlling the food inflation beyond a point with monetary policy measures. The need of the hour is to bring down the rates. Globally also, most central banks are bringing down the rates. We are in a position where there are two wars happening. So global sentiment is muted. With Trump coming to power in US, there's an expectation of massive tariff wars, right? So we are facing a lot of headwinds as an economy. So I think it'll be nice if the interest rate situation gets a move on in terms of rate cutting cycle starts, or the liquidity in the economy is improved. Also, what is very important is that the government needs to really start spending on the public side in terms of spending with both hands on infrastructure, roads, ports, all of that. If you see, the government spending has been really low this year. This really needs to ramp up, because only that will create the virtuous cycle of job creation, demand, and a positive sentiment in terms of driving the consumption growth.
Right. Mitali, do you agree? The need of the hour really to cut interest rates, to go for that repo rate cut or the key lending rate cut, as it were. We're dealing with elevated inflation, growth witnessing a slowdown, as well as globally a really uncertain scenario. Also, do you believe this is cyclical or structural in nature then for the state of the Indian economy at large?
No, absolutely. I mean, firstly, thanks, Sakshi, for, highlighting this topic and, again, reigniting the debate on this because I think, of course, it's such a pleasure to be with both of you as always. But I think every time we've met for the last, 7, 8 quarters when we are decoding the RBI press release and, when we are decoding the PIB GDP data, we've always talked about, the growth acceleration. This time we are here to discuss the growth deceleration and of course one of the lowest growth rates we've seen in GDP in the last almost 2 years. But I still want to start off with one basic note that even when this is a growth slowdown, it's still growth. It's still a quarter where we've posted a growth of 5.4% in the overall GDP despite all of the headwinds that Sanchita spoke about. So I think that's the first point to kind of take away and say growth nahi ho raha hai kya? No, of course growth is happening. That growth might be a little bit slow in this particular quarter, and I think this is what we call in economics a typical cyclical effect. So if you look at where did the slowdown occur, the major part where the slowdown was actually seen in this quarter was in manufacturing. In the similar quarter, Q2 of 2023, we saw manufacturing grow by 14.3%. Now, in this quarter, we saw manufacturing only grow by 2.2%. So, of course, this is going to impact, our overall GDP, sort of calculations. And on the other hand, sectors like agriculture have grown by 2 times in this quarter. So we saw a 1.7% growth in agriculture in Q2 2023, but in Q2 2024, we saw 3.5% in agriculture. So, agriculture growth is actually rebounding. Then when we look at services, nearly all of the services except for construction have actually seen a slight increase in Q2 of 2024. So we are seeing that in 2024 versus 2023, agriculture is recovering and services are recovering, but manufacturing, mining, and electricity, construction, these are all coming down. What does this show us? It shows us that there are 2 sectors where we clearly need to see more of a push. The first is private investment. We saw a massive decline in private sector investment in this quarter, which we didn't see in consumption, by the way. Consumption has still increased. Government spending has also increased, not much, but it has actually increased. So what does this entire story tell us? This entire story tells us that somewhere in 2023, when the PLI scheme was launched, we saw a lot of FDI coming in. We saw a lot of manufacturing investment coming in, but that's kind of reached a peak, in the cycle. So now we are seeing that cyclical effect of declines in the private investment. Plus, when you add what Sanchita rightly said, cost of borrowing has increased to that extent that there's a liquidity crunch. So if we don't ease that cost of borrowing, we won't be able to then get out of this slowing cycle. So all the conditions are kind of right for an interest rate, revision.
Right. But in the long term and in the near term, if there were sectors that I would say, that you would be bullish on, Sanchita, very quickly, what would you say?
Sorry, I think I was on mute. I would say that sectors which still look very good in terms of which will now be the need of the hour to be addressed by the government. And as Mitali rightfully said, even private investment. Private investment always follows expenditure by the government and FDI interest. would again be infrastructure, in terms of there's massive demand on the electrification of the country, right? Power is a huge, for a country which is going as fast as ours. The power consumption, so electricity, infrastructure, roads, ports, real estate, we haven't even touched the tip of the iceberg in terms of an offtake, affordable housing, cement, construction materials, infrastructure. Financial services, definitely yes, because I think right now the whole situation is a little muted given the very tough credit lending norms. And post the revision of the regulations and RBI monitoring and coming into a comfort zone with the loan to deposit ratio, I think once the credit offtake starts off, financial services, insurance, all of this would be very, very meaningful. Also, I think Mitali rightfully pointed out that manufacturing is struggling. And why is manufacturing struggling? Because there's a lot of ambiguities in the PLI scheme in terms of, again, cutting through the red tape, the bureaucratic hassles. Will there be a trade war? Will there be a tariff war? How to address the export situation within manufacturing? Because India has become a very, very significant exporter in manufacturing. So if we are actually saying that we are a credible alternative to China, and we are trying to cut across barriers in terms of being the factory to the world, even within manufacturing, we need to remove these land and labor reforms. We need to have these ongoing. So I'm very hopeful, even with the winter session of the parliament, we need to address, the red tape and the ease of doing business bit. And cut across these lines so that we become a very credible alternative and we become an attractive destination for FDI investments. And definitely, I think right now the crux of the matter lies in proceeding towards a low interest rate environment, keeping the liquidity afresh, because all of these directly affect the manufacturing sector. If I'm a promoter and I'm running 2 factories, I will start a 3rd factory and take working capital loan at a lower rate. Why would I take a working capital loan at a higher rate in a situation where I know that my export numbers might be ambiguous? I might be socked by tariff tomorrow. I might have an urban demand decline. I would need support from the monetary policy, from the government, in terms of a lower rate interest environment for me to be putting up that 3rd factory.
Right, Mitali, sectors that you feel will need attention and sectors that you'd be bullish on going forward.
So firstly, I completely agree with Sanjita with the point on tariffs, because if you look at the numbers on exports and imports, in this quarter and versus the previous year. So Q2 2023, we actually saw exports growing by nearly 12%, I mean, that's unprecedented. Even in many, many quarters, we have not seen such a high growth rate on exports. And then in Q2 2024, cut to the present picture, we are growing exports only at 3%. So there's a massive reduction in exports overall. There's also a massive reduction in imports. Actually, if you look at imports is minus 3%. So our imports are not grown. In fact, they have decelerated. So there is a certain amount of import substitution which is taking place, and that's good because we are obviously, that is also a kind of indicator of being able to manufacture a lot of goods and services for your own consumption in the country. But still, exports are an important engine for us because exports are really how we want to power our economy going forward. And as Sanjita said, once you put in those tariff threats, then you are not sure about your manufacturing decision. I think what I would actually bank on again going forward, and this is something which even in our school books, we used to, when we were studying economics, even in school and college, it was like a constant discussion of India kind of being a country which has skipped the manufacturing phase and gone straight into being a services economy. So even today, I would put in my money on, our services sectors, which are doing really well. Like your IT sector still, despite tariffs, despite everything, today we are not just an outsourcing hub. Today we are a hub of IT innovation. Today we are a hub where a lot of even American companies like SAS, or even a lot of other American companies like IBM are coming, setting up massive campuses in India and investing in people's skills. So I would still say, a services sector like IT, fintech, financial services, these are areas where India is becoming a partner to its Western counterparts. So it's not just an outsourcing or cost saving exercise. But on the on the manufacturing side, I really think that there's a lot to be done on electric vehicles. There's a lot to be done on renewable energy components. There's a lot on auto components, auto parts, and of course commercial vehicles. Which are really coming up as sectors which are doing well on investment. Sort of bringing in the investment. But I do think that we need a focus on, sectors that we may not have thought of before, like food processing. Everyone thinks that India is saturated on food processing, but we are not, because we are not meeting the kind of quality standards that are required for exports or even for textiles. We're not exporting as much as we can. So I think if we have to become export leaders in some of these sectors, and these sectors also have potential for gender equity, because food processing and textiles are sectors where we see a large proportion of women led enterprises, but we have to take them to the next level in terms of integrating with global value chains. So I think these are really sectors where we have to have more of a focus. But today, I would still say services, fintech, IT, and manufacturing, EVs are the main leader for me.
Right. So there are bright spots, as they both explained, in the India's economy at the moment, but there are also areas and sectors that do need attention going forward. The spotlight really on RBI's monetary policy and the state of the Indian economy. Thank you both for sharing your thoughts.
Thank you so much.
Thank you.